If you trade smart money concepts or ICT, I have literally the best indicator known to mankind for you guys. And it's free. Welcome back to the channel, everybody. My name's Artie, and this is The Moving Average, a show where we discuss everything day trading to keep you profitable. So what you want to do first is head on over to TradingView. Open up any chart. Doesn't matter what you're trading, as long as it's not crypto. Indices, Forex pairs, commodities, this works. Click the Indicators tab at the top of the screen, type in TTF SMC, and it will be the TTF SMC Toolkit by the trade floor. Add it to your chart and add it to your favorites. The first thing you're going to want to do is click the three dots, the more icon, change the visual order, and bring to front. Now, I would love to explain every single aspect of this to you, but one of my friends has already done so. So I'm going to let him take the reins because literally I couldn't have explained it better if I tried. Once you finish watching him, I've got a few more things I want to add to this.
Hey everyone, it's Jenks, and I'm here to present to you the trading floor's brand new SMC Toolkit indicator. The indicator is compiled of various tools, and while they aren't meant to be used all at the same time together, you can absolutely combine more than one of the concepts together to assist you in either forming a trading plan or bolstering the probabilities of an existing one. Please note, for the best functionality of this indicator, click the three dots next to the name of the indicator, scroll down to visual order, and click Bring to Front. The original focus of this indicator was to assist traders in finding and utilizing mechanically drawn levels every trading day. I'll show you in this video how to turn on and off each of the features within the indicator. I'll also give an explanation of how each of the tools work and the function it serves, as well as giving you an example of how you can combine the tools within the indicator to form a mechanical trading strategy. First up, we have the midnight and 8:30 a.m. New York price lines. To turn this tool on, you come into the settings of the indicator and click Display under the New York Midnight Open and Display under the New York 8:30 Open. The concept for using these two price lines as levels every day stemmed from ICT methodology and states that the Interbank Price Delivery Algorithm, or IPDA for short, resets at midnight New York time every day. Price tends to respect this midnight price line in so much that you generally be looking for longs below it and shorts above it. You can also visualize these price lines as magnets that will pull price towards it in an attempt to keep fair pricing intact, and then eventually the magnets let go and price will take off in its true intended direction. In these cases, you can often find the price lines acting as faux support and resistance. You can continue to see in this example that every time price came up, it rejected the midnight line. We look back to the day before, see the midnight line gets established, price breaks it, and then retests it once again before going off in its true intended direction. Using this knowledge, you can quickly scroll back through previous price data to see how this holds true on most days. As with anything, nothing is 100%, so please do your own backtesting to see how this could fit into your trade plan. Next up, we have Williams fractals. To turn on the Williams fractals, we're going to come to the Styles tab and check the Filtered Top Fractals and Filtered Bottom Fractals boxes. First and foremost, it's worth noting that Williams fractals print late. When you see a fractal above or below a candle, that fractal printed 2 candle closures after the candle being denoted by the fractal. So for example, this top fractal would have printed at the close of this candle, and this bottom fractal would have printed at the close of this candle. So how do we use this in our trading? Well, we can use the fractals as a mechanical way to denote market structure or structural liquidity. From there, we can form multi-timeframe price ranges. So let's hop up to a higher time frame to set that up. First, to make things easy, let's look for a recent turnaround or pivot point in price. This is a place where price very clearly shifts from a bearish market to bullish or vice versa. In this case, we have a bearish market shifting to bullish. So let's zoom in on this low candle. We can use this fractal low as a range low and place a horizontal ray on it, denoting the low of the trading range that we're interested in trading in. From there, we trace backwards to the fractal that caused this low candle, and that would be this fractal, so we place another ray there. Now we have our range low and our range high. And since we scrolled price back to the pivot point, we know that price is immediately going to be breaking this structure. Every time you have one of these ranges break, you can consider that a break of structure. We can mark it just like that. There we go. Now, when we move the range high because of a break of structure, we would also be looking to drag the range low to the fractal that caused that break of structure. You can see that this fractal gets formed and goes on to break structure right here. Now we're just going to keep doing that, continuing along the way. We have another break here. We bring it to the most recent fractal. We have another break here. Bring price to the most recent fractal. Another break here. And no new bottom fractal prints along the way to the breaking of this. So we go ahead and just leave this bottom horizontal ray where it is. We have another break. And we can drag price to the most recent bottom fractal that would cause that break. We continue on. There's no new fractal printed here. So we just continue on. We have a break here. And then we would drag the bottom horizontal ray all the way up to the fractal that caused that break. Now we have a bearish break. We would drag the bottom ray down. No top fractal was formed in the meantime, so the top fractal does not move. We have another bearish break. And now we can move the range high to the fractal that caused that break, which would be this one. And similarly, as we keep going forward, we have another break here. The fractal that caused that break is this one. There is a minuscule break here, so we will cover it. And then we can drag that to here. And then our top fractal range would be moved to there. And then you can see we continue the bullish momentum. This would go here, denote a break of structure. This would continue to drag up. Likewise, this would drag up, denote the break of structure. Here's the fractal low that caused the break of structure. And now we can just start dragging this to the most recent price. Okay. And then this would eventually get dragged, earlier on it would start here. Then as price keeps developing, this would eventually move here. And now, most recently, this is our fractal price range on the 4-hour. I first learned about using Williams fractals to form multi-timeframe price ranges from Scott Taylor and Evolution Markets, and they have a great mechanical way of using the fractals and ranges to form a bias as well. For general use trading, it's often best to just default to the tried and true method of buying low and selling high. So let's take our 4-hour range and plot a Gann box to denote the equilibrium, which is just the 50% line of any given range. Now that we've identified our 4-hour range high and range low and drawn our equilibrium to denote the premium and discount zones of the 4-hour range, we can hop down to a lower time frame to look for reasons to go long from discount or short from premium. The last tool that aids with drawing mechanical levels and biases is the DR-IDR tool originally developed by the master. To access this tool, we come into the toolkit and come down to the DR-IDR section and click any of these 3 boxes. For these 3 boxes, regular denotes the time during New York Stock Exchange trading hours, after denotes the time during the Tokyo and Asian trading session, and the overnight denotes the European or London trading session. From here, you can choose stylistically to shade the box using the IDR or DR. You can change the box line width. You can change the colors and whether or not you want the lines to be solid or dashed. You can change the middle line color, solid or dashed as well as the opening line. You can also change the background color of the box. You can effectively use these style tabs to turn off any features you don't want. Now that we have it loaded up on our chart, let's figure out exactly what DR-IDR is and how it can help us in our trading. DR and IDR highlight these 3 critical times of the day and draws the defining and implied defining range using the 5-minute candle, bodies, and wicks. Let me show you exactly what I mean by that. The highest wick created by a 5-minute candle during the DR time frame is considered the range high or the high of the defining range. The low wick of that same time frame is considered the DR low or the defining range low. The body closure high of that same time period is the IDR or implied defining range high, and the lowest body close is considered the IDR low. From there, the midline is calculated using the IDR. You can see that the equilibrium of the IDR serves as our midline. The theory behind DR-IDR is that once this range is formed and broken in one direction, price will not trade past the other extreme of that range. Let's take a look at this example right here. Price comes up, breaks this range bullishly, retraces, and then makes another bullish move out. Now, this isn't 100% accurate, as nothing in trading is, but this concept alone, this piece of the overall DR IDR methodology, boasts a nearly 80% historical accuracy. We can use this kind of historical accuracy to form a bias and find trade ideas during our trading day. I strongly encourage you to check out Alex's streams for more info on DR and IDR, as he is a very well experienced trader using this methodology. The last tool we included in this indicator is fractal Wyckoff accumulation and distribution. This tool is more of a potential entry trigger than it is a method for finding mechanical levels, but it pairs very nicely with any of the other tools that you find in this kit. The strategy that this indicator comes from is called the Triple M strategy, and it was developed by MentFX. The idea behind it is that if each individual candle is a whole price range on a lower time frame, then we can use scenarios highlighted by these wicks to denote the fractal spring or upthrust after distribution phase of a Wyckoff schematic. These springs and UTADs can serve as an entry trigger when combined with other confluences, such as previously established biases, points of interest found within areas of high probability, as well as kill zones. Lastly, here's an example of how you could combine these indicators to form a trade idea. First, let's establish a higher timeframe price range using the Williams fractals. Just as we did before, let's come to our lowest low where there's a fractal printed, and mark with our horizontal ray the bottom of that range. Now let's trace back to the fractal that caused that break, and we get this one. Now as we continue price forward, we see that this fractal gets broken in the form of a break of structure right here. And then the fractal that caused this break of structure is this one right here. We move the range low. Now that we have our higher time frame range drawn, let's go ahead and use the GAN box to put in our equilibrium to make sure that when we go down onto lower time frames, we're operating within our fair pricing model and buying low and selling high. One last thing, let's turn off the Williams fractals just to declutter a bit. Now that we have our higher time frame range marked up as well as the equilibrium, let's jump to a lower time frame and see if we can get a bias from our DR IDR tool to match up with the fair pricing model left behind by the higher time frame range. When we do, we can start to look for entries using the Wyckoff wicks. This is what we're looking for. Now that price is broken out of the DR range, it is established that the bias is bullish for the rest of this trading session. Since this bullish bias appears while we're in the discount of the greater 4-hour range, I'm interested in participating in the market. Let's look for a Wyckoff wick during a retracement to give us a clean entry signal. Here we go. This is exactly what we're looking for. Price confirmed its bias by exiting the DR range. It retraced to the DR range. It gave us a Wyckoff accumulation in the form of a spring, and we're looking to go long here. At close of candle, we would cover the swing low, in this case being this candle itself, and let's just target conservative 2R. As you can see, this trade goes on to be a winner. I want to reiterate to you guys that what I've presented to you today is not a formalized, back-tested trade plan. This is an example of how you could combine these tools together to form a trade plan. I hope you guys enjoyed trading with this indicator, and if you have any questions, please feel free to ask in chat. Have a great day, and I'll see you next time.
Now, I've been playing with DR and IDR for many, many months, and the results have been absolutely astounding. And I've been using these techniques and these strategies when implementing them into my bot. Trading during specific hours, not trading during that first hour of each market session open, the DR IDR range, waiting for those breakouts and retracements, whether it's a Fibonacci level or an equilibrium point or a premium or discount. And one of the most crucial parts is trading the midnight line. Now, if you guys watched the last episode of me making a bot, you know how my bot's performing, and it's trading very, very well. And it's based solely off this information. The reason I started developing my bot the way that I did was after making the SMC course, the ICT course, the price action course, I started to see patterns that I did not see before. I implemented those patterns into my day trading strategies bot, and it's just golden. So I highly suggest using this toolkit if you want additional information and you want to learn everything there is to know about price action, SMC, and ICT. Check out the courses at trdfloor.com. Link in the description.